Thanks so much for tuning into this earnings conversation with Sona BLW or Sona Comstar, whichever way you identify the company as. But the man to talk to is Vivek Vikram Singh. They've come out with the quarterly numbers yesterday. The revenues maintain about a 2% odd growth, a slight slippage in EBITDA, but considering the input cost pressures, that was to be anticipated. Maybe Vivek has a different story or a spin to it as well, and I'll talk to him about that. More importantly, an end of a year which is for the industry at large is the end of a financial year which is established EVs as not a thing of the future but a thing of the present, and Sona, it's trying to or not trying to, really has now firmly established itself as one of the key suppliers of that ecosystem. And Vivek, the conversation today, I would love to split it into one, the financials and the numbers that went for the quarter and the year, and two, how do you see the roadmap ahead over the course of the next 3, 4, 5 years, and what kind of growth journey do you envisage? But thanks for joining in today.
Thank you for inviting me, Neeraj. It's always a pleasure to talk to you. So first up, no spin on the numbers. The numbers are what they are. If you have to explain the numbers, maybe we haven't done a good enough job in producing them. So our job as management is to produce results which speak for themselves, and we don't have to explain them. It is helpful, though, to understand the context. The context is that our industry is under enormous pressure. Global light vehicle sales, which would perhaps be the best benchmark to compare our performance, has been slipping now for many years. It used to be 95, 96 million light vehicles were sold annually. And if you take last financial year, FY22, it was less than 80, 79. So in the last 2 years, that's the first year as Sona Comstar, as you rightly said, when we acquired Comstar and became Sona Comstar. The global light vehicle sales have reduced by 7%. In the same time, our sales have gone up by 75%. And any company should be looked at. Any company, any individual's performance has to be looked at as a contrast with the industry they operate or the context that they work in. We don't exist in a vacuum. Now, 75% is very good growth. On the quarterly basis, you're right, margin pressures are there. And we think they'll continue for 2-3 quarters. And I always say it, even to my team, that percentages aren't the really material thing. It is the absolute profit. And if just because of mathematical calculation of numerator, denominator, because whatever material prices we get, we pass through. Because of that, percentages slip, it's okay. Because these are cyclical and event-based occurrences. They're not structural. Our business model hasn't changed. 2 quarters, 3 quarters, 4 quarters, there will be a time. See, inflation and high economic growth, both are not going to continue together for some time, right? It can go on 1 quarter, 2 quarters. Something will give. Material prices have to cool off. When? That's the question. And when it does, margins will come back. So that's the short of this quarter. The year was fairly good, I think. 36% revenue growth. Transmitted into profit, I think the profit growth is very high. Net profit is, I think, up by, if I'm not wrong, 68% for the year. However, there are some one-time exceptional items, and many companies don't, but we adjust downwards almost every quarter our profit so that people should have the true picture. Adjusted basis, I think 37%. So every rupee of sales growth has eventually yielded in 1 rupee of extra net profit growth. That's the main goal. That's the thing we work for, which is net profit and EPS should continue to rise in line. That's how we try to manage.
Got it. There will be the obvious follow-up question to this would be, and I'm first sticking to the non-BEV segment because those sales getting impacted due to chip shortages likely impacted your revenues as well. Now, is it possible to predict the impact of chip shortages when it could end? And I'm guessing no, but would want to understand from you. And if that is indeed the case, do the next couple of quarters look highly unpredictable?
So Chip shortage impact, we had actually spoken in our first earnings call in August. I had said minimum 18 months, even at that time. So I would say I would hold to that, perhaps add 3 more months because of the Russia-Ukraine situation. But that is the minimum time. This is a fairly big problem. It doesn't get solved overnight. I think a lot of our peers were optimistic in assuming it would. So we budgeted accordingly. The new problems that we hadn't factored into our budget were, of course, the Ukraine situation and the lockdown in China, which could have an impact, not just so direct impact, maybe not that high, but it is decent. 18% of our sales are Asia, out of which China is the largest market. So as a direct impact, yes, there is. That's why our last quarter sales growth wasn't as much as it could have been. I mean, if you look at Europe plus Asia, that's 45 to 50% of our total sales. And those two markets in March were really, really horrible. So despite all of that is our performance so far. And even next year, all I can say to investors and your viewers is that, look, last 7 years, as an average, we've grown by about 35, 36%. So I don't know about exact percentage, but even this year, we'll have strong double-digit growth for sure. That is something we know because, and we say that while assuming a slightly negative growth on the existing business. Just because of the new programs that are launching, just because of the new customers or products we have. So we are only relying on new additions for growth. To rise with the tide of industry, that has been ruled out for a long time. I think last 4 years, the tide has been shrinking. But you know what I always say is that maybe it's not such a bad thing. This is really a good time for all people to know which are the companies which can weather these challenges, which when the tide is rising and everybody is benefiting, times are good, everyone has growth. If you grow in these headwinds, that's the test of true character for a company, for an individual, for a leader. And we don't always get the opportunity. So I'm in a way thankful that we have challenges. It helps you prove your mettle.
Yeah, no, but and hence you get the valuations that you do, Vivek. So I mean, the market in some fashion truly rewards you and a few other players for the kind of work that they are doing and the kind of opportunity size that is there vis-a-vis others. So in that sense, there is a bit of a quid pro quo that is attached right here, right? The only question I think that comes to mind is that in a scenario which is volatile and you know, you mentioned China, and I'm trying to wonder out here that the lockdowns in Shanghai and the production issues, as well as the shipping issues and the freight issues, do they add a dimension which makes the near term truly unpredictable?
See, this is why talking to you is such a delight, because you've gone to the second order problem. The first order problem is actually not that big. What is the direct impact on your sales? How much? It's 18%, will go to 15. What will it impact? Not that much. The indirect impact, or actually the induced impact, if trade itself starts getting affected. Auto industry is one of the larger discretionary spends for any individual anywhere. Second part, which is commercial vehicle, again, is a factor of economic activity in that country. Goods are transported only when they are production and demand for the same. Otherwise, they will not be. If this persists, the ripple effect will be very large global macroeconomic effects. And that, I think, is a very serious concern that we are watching out for. It will be much larger than our company, our industry. I think this is going to be a global macroeconomic impact if they don't sort it out. However, I just hope, and this is just hope, that common sense prevails. The lockdowns seem to be far more stringent than the effect of the disease. If the medicine is worse than the disease, I hope common sense prevails. It's just not normal to continue like this. So that is a big one. That could disbalance everything in that sense.
Got it. Vivek, the other question that I would have is that there's a lot of talk across various industries about China plus one, right? Now, my wonder, does this situation wherein, as you said, the medicine is more stringent than the disease, does it make more people look in your, I mean, in your customer set, think of even more actively diversifying China plus one, and therefore does it open up the opportunity size for leaders like you?
So again, a great question. It is actually happening, and this time, actually, this lockdown has prompted a much bigger China plus one shift than I think everything that happened last 2 years. Those were more political, so the companies were taking it as a political inconvenience for which they have to alter supply chain. This time, they are saying, if a regime or a country is an unpredictability is so high that we don't know anything of our production itself, maybe it's best. This is a much more urgent need to do China plus one. And this time, I can tell you from what we are hearing from customers and the tone has changed. Earlier it was, let's do this, give us a plan, we will see. Now it's like, when can you do this? So it is a big opportunity for India. And again, it is for Indian manufacturing leaders specifically. It is an opportunity for them to gain or lose. There are other countries out there who also compete with the manufacturing pie with us. If they have good governance, rule of law, and people believe that they have the decent infrastructure and skill sets to deliver, they will also take a bite out of this opportunity. So it is for us to make what we can of this opportunity.
Okay. So Vivek, okay, let me continue with this train, then we'll get to the minutiae again. A lot of things that you are probably doing have a slightly longer results gestation to themselves. The newer partnerships that you've stitched, and I've seen a string of announcements in the last 3 months, some of which I don't even remember or have noted down. The whole electrification thing, while it is truly here, might probably have a Jacob effect, if not, maybe not now, but a couple of years down the line. Plus this whole China plus one conversation, even if you're getting into very serious conversations, I'm guessing shows results, maybe not immediately, but a couple of years. Can you talk about how, if things normalize, how can the industry run rate and your own run rate shift from where it is right now over the course of the next 3 or 4 years?
So I would say an important question. I think, the difference between good and average companies, in my opinion, is not that good companies do a lot more of something. We don't invest more capital or throw more people or engineers or spend more. We think slightly differently, and I think the mindset is our biggest competitive advantage, not just product edge, technology edge, just the way we think about the world. I mean, if you look at our differential assembly business in battery electric vehicles, today it's about 450 odd crore, if not more. In 2016, when we started it, it was nothing as a percentage of revenue, and the entire electric vehicle market of the world was nothing. But we started because we had a firm view of the future, and we chased that vision down. Even today, what you're doing, and you're right, in the motor thing, you said so we've had 3 announcements: IRP for a magnetless motor for 2-wheelers, Anydyne for 3-wheelers and 4-wheeler LCVs, and just yesterday, C-Motive for electrostatic motors, which is no magnets, no copper, nothing, dielectric fluid, for industrial bots that can move around, warehouse automation, etc., plus the tractor segment. Wherever there is, I would say, low RPM but high torque requirement, electrostatic works fine. Some have production in 2023, some 24, some 25, 26. The trick or how we are looking at this is this: there is every end segment that has to be electrified has a very specific consumer need. So the guy who buys a $1,000, sub-$1,000 electric 2-wheeler does not need great acceleration or great features. For the large part, what they want is how many miles can we do upon the total cost of those miles. That is what they want, because it's an economic asset. For the $1,000 person, aesthetics matter, style matter, features matter, acceleration matters a lot. So torque is far more important, but from a very peak power is important, not nominal power. If tractors have a very different need, again, range anxiety is lesser because you are working mostly in the farm thing. Electricity could be very highly subsidized and hence electricity is cheap. Electric tractors make so much sense. The torque is very high because the wheels are very heavy and have to rotate, but the speed isn't necessarily. So that is a different product. So these are all different solutions. Imagine them as different locks. We want to make the right key for each lock and then go to our customer. What we're trying to do is build this problem-solving attitude rather than say, we have made BLDC and PMSM motors, let's try to make variants of this and try to sell to everyone. No. Start with first principles. What is the consumer's problem? What would help our customer? If you always keep whoever is your customer, and everyone, all of us have a customer, if you put them ahead of everyone else and then go about what you're doing, I think that's a good recipe for success. So long-winded answer, but I just thought to give you a glimpse of how we think about this. We don't necessarily make business plans with TAM and IRR for everything. We think this. Is there a problem? Is it sizable enough for the customer? Can we solve it via better engineering and better economics? Better economics come, why we saying no magnets? Not because we hate magnets or something. Magnets are fine. Although I don't like how they are mined, but it is because only by reduction do we make products better. Engineering design improves if you reduce parts from it. The less the number of parts, the less the complexity, the cleaner the design, you also bring down material cost. If your cost is lower, your right to win is much higher. So yeah, a lot of factors go into it. But again, I would say summary is this. I think mindset is what is different about it.
Okay. So bear with me for a second, but I'll lay down the crux and then ask you my question to get the answer that I want, right? You have a mindset, you have the capabilities, you have a string of partnerships, stroke orders that have come in, some of it which maybe materialize after 2 years, some after 3 years, what have you. And the current business goes on as is, cross fingers, improves even more. My question therefore would be, from the place that you are at to the place that you can be 3 years down the line, would it be a steady state move, or at some point of time you suddenly take a quantum leap from this moti 500 crores, 550 crores quarterly run rate to a slightly higher number?
Yeah, all leaps of electrons are from one orbit to another. So we will enter a new orbit, hopefully soon. I can't say with exact certainty because the macroeconomic situation is so unpredictable, but it won't be too long. It won't be too long. Again, we were a 350 crore company in 2016 when I joined this business and started up. From 350 crore to 2100 crore, we've taken what, six years actually. 6 years, 6 times. So yeah, we have continued doing it. We hope to continue. And I'm again repeating, it will be the mindset that will get us, because you have to keep introducing new products, keep solving new problems. We should see good growth for the next 3-4 years. And if you look at order book, which is the more concrete answer to this, that's 18,600 crore, right? That's a 10-year net order book. Divide that by 10, you get 1860. So on an average, and we are 2100 something this year, right? So on an average, the next 10 years are 4,000 crores. So next 10-year total revenue, if I do nothing from now, if we sell nothing, no new orders, we should have 4,000 into 10, 40,000 crore revenue is 10-year aggregate revenue. So that is done, but we got to build more. We got to build more products. We got to sell more. We got to win more customers' hearts, and we got to keep delivering on this. So that's the plan.
Okay, well, and that's good to know. So now the couple of other questions, and then I understand it's lunch hour, so we'll let you go. But a couple of other questions. In order to achieve some of these and set the ground for some of these, you will need to do CAPEX. I think the declared numbers are between 900 to 1,000 crores. My question is, considering how steep the input cost pressures are, does the ROI on the CAPEX that you embark upon currently or have embarked upon in the last 3 months, does it get extended materially? And therefore, do you think that you might even want to delay some of the CAPEX which may not be very, very critical currently?
Not really. So our CAPEX, our returns are fairly good. So for every 1 rupee of CAPEX, let's say, we do get 2 rupee of revenue. So right now, let's say at 25% EBITDA, you get 50 paisa back. So 2-year payback. Now this 25% goes to 23 or goes to 27. It doesn't materially affect your paybacks, right? I mean, 1 year, 11 months, and 2 year, 1 month is not going to change how you look at CAPEX. So not really any need to delay. 900 to 1000 crore is what it looks like with the current order book. If you add to the order book, it will go up. Is what it looks like. We're fairly prudent about CAPEX. We have a very, I would say, firm grip on the tap. CAPEX is a flow, and we are watching it. Reversible decisions we take with full agility, because we can take them back. But irreversible decisions, we are watching, I would say, from a flow perspective. Most of the equipment we buy is Japan and Germany. So there isn't that much sensitivity to be, payment terms are very important, not just the quantum. That, instead of paying it in 3 months, can you pay it in 6 months? Because we can make up that return loss from just altering terms. So yeah, we are very frugal. Like I said, we started from being a 350 crore company with high debt, negative net worth, etc. So frugality is in our bones because, when you've not had enough money, you treat money with a great degree of respect and you use it well. I think some of the problems that a lot of new and young companies have is they get too much cash too quickly. And, cash is oxygen. You need enough of it to live. But if there is too much oxygen, it burns. And that discipline is ingrained. And we are almost all of the management is, middle-class background. So we respect money a lot. And how we spend it is return first. Return is our biggest thing in finance. Actually, return, growth, margin. So margin, I don't worry about that much. Return, growth, margin is the order. If return is high, even if margin is low, you should do it.
Would margins get impacted too much in the ensuing 2-3 quarters? Or is there a lever for cost saving internally which might help offset the pressures?
I don't think margins are that volatile, actually, to be honest, anyway.
So it's not showing in your numbers, but just wondering because of the whole conversation around input costs. That's what I'm trying to figure.
It will manage because we have operating leverage is pretty decent. Fixed cost is very low for us, right? Most of the cost is variable. And yes, there is so let's say our long-term range has been 26-27% for the last 7 years, ever since I've been here. There are quarters in the past also where it's gone down to even 24%, 23%. And there are quarters when it's gone up to 31%. But that's not a very wide range that would worry you as an operator when you are firmly, your North Star is growth in this case and returns. You can be a little inflexible. Yes, if it were to start going to like 20% and all, we would then start saying, oh, we need to change something. Fixed costs are low. Employee costs are not very high for us. There is very little other fixed costs that we have anyway apart from employee costs.
Okay. Vivek, my final question, and that is the increasing share of the EV side, right? Now 29% at end of quarter 4, 25% for the year, if my numbers are not completely off. And some of this might have been unplanned because the non-electric side also came off a little bit. But where do you see this moving over the next whatever time frame that you might want to say? And just maybe I've asked this to you before, but we want to understand again. Would this typically be a higher ROI, higher margin process, or not necessarily? I mean, you wouldn't kind of differentiate between the two.
Okay, so I'll answer both parts. So your numbers are absolutely correct and your inference is absolutely correct, which is intelligent. Most people don't get it, that from 14% to 25% in a year is also because the non-BEV is shrunk. Actually, averages and these percentages hide a lot of things because people don't get that if you put your head in the freezer and your foot on a fryer, average temperature might still be okay, but both ends are suffering. So people should factor that averages hide things. It is because of that. So the percentage growth has become much more pronounced because of this, but the journey is that. If you look at our order book, 62% is EV, right? So 62% of incremental sales is EV. Today you are at 25. Average this and you get the number for the next 10 years. Median will be what? So median is now 87 upon 2, 43.5% is your median year. That in the next 10 years, if you took the average, 43.5 is already EV. But what will actually happen is more and more orders, actually non-EV or ICE orders are not that easy to come by. There are not that many programs launching. So it will naturally keep increasing. So 43.5 is almost like guaranteed, but increasingly it'll just keep going that way. I mean, there will come a point in 2035, 36 is our prediction, then it will be 100%. So you won't be an EV supplier. You will just be a vehicle supplier because all vehicles are electric, right?
Right.
Second part, so different for I would say the EV transmission business where we have differential assemblies and now we also do a lot of transmission parts starting this year. Returns are what our average returns are, but margins are also what our average margins are. So very similar profile. In motor business, I would say margins are lower just because we are catering to the electric two-wheeler, three-wheeler segment, which is far more price sensitive as a customer. But the returns are much higher because it is a low CAPEX business. It's a more capability and hours business. Like you make controllers, right? So you have an SMT line, which is just an electronic thing. You already bought the board. Most of the time goes in coding. So the CAPEX here is not very high, but the time is there. So it's an OPEX thing. So margin goes down, returns go high. So it's a balance. As the CEO of the company, have to look at our entire product basket and then see, okay, we do this slightly lower margin but high return. This we do slightly higher margin but lower return, and you balance it all out so that we keep the company on the same track that we want. So that's how we are doing it right now.
Well, all the best for maybe doing it as you are or even better. But lovely talking to you today, Vivek, and thanks for explaining this in great detail. Really appreciate this.
No, always a pleasure. It's good to always have conversations which are second order, third order, because merely reciting the numbers you did in the last quarter, I don't think I'm really required for that. You can just read them because numbers are just numbers, right? They exist and they tell their own story. But for what is behind the number, where this is going, how we look at the future, because look, the industry will come back. I mean, we were 95 million industry, we are right now 79. Okay, maybe it doesn't go back ever to 95, but it will go back to 85, 87, 90. And when it does, suddenly like a spring, it will go up for everyone. In that time, it will be good to remember the ones who were good and who were merely average in bad times. And that's the thing that's the message I'd leave you with. On the thing you had mentioned on valuation, etc. After the IPO, I've frankly never thought about it because the job of the management and my specific job is to follow our strategic priorities. We have 5 KRAs that we transparently share with all shareholders and then report as honestly, as transparently, the numbers, what they mean. A lot of people say, oh, the commentary was pessimistic in the earning call, etc. We're just telling it like it is. There is no point sugarcoating macroeconomic realities, which if you have opened a newspaper or a TV channel, you know what is going on. There is a war right now. One of the largest economies of the world is locked down. The second largest commodity producer has been sanctioned. Things aren't that great. Inflation is very high. All central banks are increasing rates. Saying this does not make our prospect better or worse, right? It is just a commentary on what is going on. Yeah. And that's our job. We'll try to continue doing it and leave investors to take decisions as per their wisdom, their prudence. We will continue doing our job, not in the hope of any of that outcome. Our job is to run the company the best we can and keep it on the path that we've shared with everyone.
Great going. I would say keep that up, because that will hold you in good stead in the long run. So keep that up, and thanks for sharing that as well today.
Thank you, Neeraj. Thank you.
It was ours, and then viewers, thanks for tuning in to this conversation.